Let's talk about mutual funds. And mutual funds have a very long-term time horizon, unlike hedge funds. And there's two different types of investment philosophies I want to briefly introduce right here. And one of them is called growth investing, and the other one is called value investing. And we'll talk a lot about this in this course, and you have to know what your boss is. Is she or he a value investor or a growth investor? Very important. So in terms of the who, what, where, when, why, how of mutual funds, we have Mo here, our mutual fund analyst, to help us out. So let's kick it off by talking about who can buy mutual funds. So anybody can, right? Anybody. Unlike hedge funds. Hedge funds, you have to be an accredited investor or a very high net worth investor. Also, they're much more diversified, and there's so many different options that you can buy mutual fund wise, right? You can buy mutual funds in every country, right? From every flavor, from growth to value, that sort of thing. And it really helps you to diversify risk in your retirement portfolio, for example. So they have very long-term time horizons, right? And some of them are 3, 5, 10 years, right? Very long-term focus, right? Hedge funds, as we know, are shorter-term focused. In addition, they buy and hold, right? And they don't have shorting. Obviously, they don't bet against stocks. And the fees are much lower here, right? There's not as much risk management of longs and shorts. And so the fees are usually 0.5% to 1% per year, and that's it. There's also a tax incentive to invest in many countries, right? So, for example, in Canada, where I'm from, there's a tax incentive with our RRSP, or Registered Retirement Savings Program, to invest locally. So back in the 90s, when I was in Canada, I owned a lot of Nortel in my RRSP, right? Or tax incentivized savings accounts. Nortel doesn't exist anymore. We won't go there. Can the portfolio manager beat the indexes? She or he must be able to in order to attract a lot of capital, right? So if you just own the Qs, which is ticker QQQQ, right? That represents the NASDAQ. And so if you own that stock, the Qs, and you beat a tech portfolio manager at a mutual fund, you'd never want to buy a mutual fund again. So the best portfolio managers outperform the indexes, like the S&P, as well as the NASDAQ index in the long run. There's something called ETFs. That stands for exchange traded funds. And some mutual funds offer these. And so you can buy an ETF that just represents semiconductor stocks, or you can buy an ETF that just represents Brazilian stocks, that sort of thing. ETFs stands for exchange traded funds. And there's something called an index fund as well, right? Like Vanguard. All they do is they basically say, here's the S&P 500. You own this index, that sort of thing. And it is an enormous industry, $33 trillion in assets to be exact. Here are the biggest mutual funds in the world. So Vanguard, which is an index fund, is the largest, kind of tied with Fidelity as well. And Fidelity basically gets you access to any type of mutual fund product, right? They'll have domestic product, international product, tech sector product, agriculture sector product, etc. You name it, they've got it, right? And then you've got PIMCO, T. Rowe Price, Oppenheimer, Dodge & Cox, and a bunch of other great ones. But as you can see, their assets under management are enormous. And this industry is way bigger than the hedge fund industry. Apparently, the first mutual fund was founded in 1774 by a Dutch merchant. It then became popular in the United States in the 1890s. And then it got highly regulated, right? Post the 1920s crash, because the government wanted to protect people from losing all their money. There was a massive stock market crash in the 1920s. It was awful. I wasn't there then. Okay, I'm not that old. So why do people invest in mutual funds? Well, it's because they want their capital to go up, right? Unlike the hedge fund industry, where they focus on capital preservation first and then generating positive returns second. Also, investing in mutual funds gives you great diversification from your asset base, right? You probably own your house, or you will buy a house at some point, right? And that's a big investment for you. You might have bonds or cash in the bank, but from the equity perspective side, you want to outsource the investments in mutual funds, right? And you want to diversify. Also, it helps you with your long-term retirement goals. Let's discuss how a mutual fund is set up. A mutual fund has a similar setup to a hedge fund. In this hypothetical example, we're going to analyze an international mutual fund based in the United Kingdom. And the CEO and CIO runs the company in this case. And there are portfolio managers covering different regions from all over the world. We're going to look at the Japan portfolio manager in this example. And so the Japan PM or portfolio manager has a trader reporting to him or her and a number of different analysts covering every sector. And so let's look at the tech sector. And we have a senior analyst in this case that has 4 analysts covering the following sectors: consumer electronics, video games, telecom, and semiconductors. And lastly, let's talk about where some of these mutual funds are. Okay, we sorted by assets here, and the biggest one is Vanguard and Fidelity, and they're here in the US. And then you have Barclays, which is a great firm in England. For some reason, though, there are no big mutual funds that matter in Connecticut. Not sure why. And out here in California, we've got PIMCO in Southern California. We've got Franklin Templeton close to San Francisco here. And we also have Dodge & Cox, which is a very long-term value investor-focused firm.